Hello, everyone. Welcome to the Weekly Watch. I'm your host, John Briggs. In last week's podcast, I noted that while I understood the increasing worries of recession that was partly sparked by the U.S. GDP report, I felt the fears of recession right now were going a bit too far, at least for the U.S. In turn, the fall in yields had also gone too far, with disagreement that there was indeed a Fed pivot to a dovish stance that may have been espoused after the Fed's meeting the week before. Two things this week supported my arguments. First, there was a myriad of Fed speakers pushing back against the idea of a pivot, discussing that there's much more to do and they're far from finished. The second thing is that the service PMI data in the US came in not just stronger than expected, but actually strengthened. It rose over the last month. It was a few weeks ago that a reading from a different service PMI showed significant weakness. That's more and more looking like a bit of an aberration. So growth in the US, while not great and not without concerns, holding in okay. And the Fed is telling us that they're staying on track. Of course, we're recording this before the important payroll report for the US, but as of now, this is all meant an alleviation of some of those recession fears, which has pushed yields higher in a stronger dollar. However, cue the Bank of England, which today hiked by 50 basis points, the largest in 27 years, and starkly forecast a recession starting in the fourth quarter, and not just a brief one, looks like negative growth over a long period. So here I'm going to bring in my guest today, which is Paul Robson, our co-head of G10 FX strategy. All right, Paul, just your initial thoughts on the BOE here, knowing that it's only an hour or two old.
Well, the market has taken it as a dovish hike. It's quite incredible, really. You sort of wait 27 years, like you say, for a half-point increase in interest rates, and it seemed to be taken doubly. Obviously, markets are priced more hawkishly than we were expecting. So we understand why markets have looked at some of the components of the decision to the dovish side. I think they're looking primarily at the guidance that's contained within the economic projections that you mentioned. So on unchanged interest rates, on the assumption that there's no more tightening here in the UK, the Bank of England is forecasting a mild recession. Now, importantly, on the assumption of market interest rates, so another, say, 100 basis points, 150 basis points of tightening, they're forecasting quite a deep recession, 5 consecutive quarters of negative growth. And I think markets have looked at that and thinking maybe the Bank of England isn't going to end up tightening as aggressively as previously had expected.
Yeah, that's an interesting point. So I guess that, for the outside viewer or listener, how do they marry hiking 50 basis points and then saying, well, we intend there to be a recession, or out of that, there will be a recession, even with no more hikes?
Well, they'll just square it by saying that you need a bigger or more aggressive tightening of monetary policy, a sharper slowdown in the economy to deliver on their inflation mandate, which is price stability. So they're just seeing a worse trade-off between growth and inflation. And the way I look at it is, one, I personally don't think it's necessary, and only time will tell whether they just are taking out a little bit of insurance just to make sure that they can deliver on price stability. But equally, the Bank of England are only doing what other central banks are sort of saying that they'll do, just without showing it in their economic projections. So the UK faces a very similar inflation outlook to places like Sweden and the euro area, but their central bank forecasts, are more for continued growth, which I would say isn't necessarily as credible as the Bank of England. So I think the Bank of England are just being honest in their projections that inflation, the world is just a little bit more inflationary. They're going to have to do a little bit more tightening. Inflation will ultimately undershoot target a little bit more than expected, but unfortunately, a recession looks like it's almost certainly coming.
Yeah, it's a good point. I mean, because we've taken issue with even the Fed, we've talked about how the U.S. growth outlook on a relative basis is a little bit better, but still, even when, as Powell says, we need the unemployment rate to move higher and labor markets to loosen up, but in their own forecast, they have it barely moving higher and expect inflation to come down. So there has been I appreciate the realism, perhaps, that the Bank of England is leading with, and hopefully that will become a little more common. Last question. So you've been calling for sterling, at least against the dollar, to base around 120, which has been a somewhat counter consensus view, but it has played out. So kudos for that. And think in the light of a generally still stronger bias of the dollar, but I guess one that's become more mixed from you and the team, right? Any changes after the Bank of England to your currency view from here?
Not significantly. So as you say, the main call we have around sterling is that we think it's basing around 120 against the dollar. We also think that there's scope for sterling to do a little bit better against the euro, very much in line with what I was saying about the credibility of the ECB forecast and whether in a couple of months' time we'll be talking about the ECB in a similar way to how we've described the Bank of England. So that view of cable basing, I think it's got three key pillars here. One is I think the sterling negative narrative in the market is fairly mature. I think you'd struggle to find anyone who isn't short sterling or could tell you something new that's negative about the outlook for the UK that isn't already in the price. And within that, markets are already positioned short sterling. So it feels a little bit more mature, and therefore we find it hard to understand what the new kicker is for another lurch lower in sterling, certainly against the dollar, which is at multi-decade highs against the currency. The second point is a sort of long-term fair value kind of view of the exchange rate. We think long-term fair value based on the impact of Brexit has fallen to 140, but we are trading close to 120. That's a big cyclical deviation, which ultimately we think will close over time. We think at this level you'll see increased hedging activity. UK assets might be seen as attractive given them be marked down because of the growth outlook, and people can buy them unhedged, which is important. Bringing it back to the Bank of England, those growth forecasts do weigh against that view slightly, but we don't think it's a game changer in terms of the outlook. And the third part, as you quite rightly mentioned, it is the dollar. So FX is a relative game. We understand that the outlook for the UK is bleak, but it's, we think, largely priced. For the US, I think maybe the new and important information over recent weeks is that the level of growth in the US is relatively strong, but it is slowing, and perhaps just slowing a little bit more quickly than people expect. Now, that might not lead people to be outright short the dollar, want to sell the dollar, but if you've been sitting here for the last 6 months watching the dollar go ever higher, but you think the outlook is more fully priced, do you just trim those positions? And is that enough just to support cable? And we think it is. So we're not prepared to turn significantly on the dollar at this point, but we think that the outlook is more balanced and risk reward favors sterling dollar basing here at 120.
Excellent. Thank you, Paul. I appreciate you joining us right after the meeting. Well, that's it for this week. Next week, things quiet down quite a bit, but I am watching the ever-critical U.S. CPI report, Michigan U.S. inflation expectations, UK GDP, and we also get inflation data out of Europe. Thank you for joining us for this episode of the Weekly Watch. As always, please remember to hit subscribe so you can watch our latest episodes as soon as they're available, and hit the like button so it's easier for others to find. Thank you. Have a great August.